In the last decade alone, over 30 electric vehicle companies have either suspended operations, gone silent, or faced bankruptcy. And this means one thing: EV companies are failing so terribly. Look, the story of electric vehicles was supposed to be simple. Tesla showed the way, and others would follow. But reality has proven far more complex. The graveyard of failed EV companies is growing larger by the day, and the bodies are still piling up. According to the Wall Street Journal, at least a dozen EV startups and battery manufacturers are at risk of running out of cash. Even the survivors aren't truly thriving. Rivian and Lucid, often considered the most promising Tesla challengers, have seen their stock prices plummet by nearly 50% in 2024 alone. But to understand why this is happening, we need to go beyond the headlines and look at the fundamental economics of electric vehicles. And it starts with a single, shocking reality. Electric vehicles are actually losing money for most manufacturers. Let's break this down. According to Bain & Company, a typical new battery electric vehicle, BEV, starts at a price point approximately 35% higher than its internal combustion engine counterpart. A BEV might retail for $42,000, while a comparable ICE vehicle sells for $30,000. Simple math would suggest the BEV should be more profitable, right? Wrong. Here's where things get interesting. After accounting for dealer margins, manufacturing costs, powertrain expenses, and other operational costs, that $42,000 BEV actually results in a loss of $1,000, a negative 12% margin. Meanwhile, that $30,000 ICE vehicle generates a $2,000 profit, a positive 7% margin. This stark contrast helps explain why even established automakers are struggling with their electric transitions. But if the economics are so challenging, why did so many companies rush into this space? To get this answer, let's go back to 2021, when the automotive industry was caught in what industry analysts now call EV euphoria. During this period, the recipe for success seemed deceptively straightforward. As reported by CNBC, investors were throwing billions at anything electric. Interest rates were near zero, making capital cheap and readily available. Tesla's soaring stock price convinced many that building electric vehicles was a sure path to riches. The global push towards sustainable energy created a perfect storm of opportunity. Yet this enthusiasm masked a brutal reality about the automotive industry. As Mark Wakefield, managing director at Alex Partners, explained to industry observers, Tesla, outside of the Chinese manufacturers, is kind of the first automaker to start in half a century. This wasn't a coincidence. It spoke to the enormous barriers to entry in the automotive world. Want to build an electric car? According to industry experts, you'll need at least $2 billion, and that's just to get started. Here's what that money gets you. Up to $1 billion goes into building and tooling your factory, another $500 million to pay your suppliers for their specialized equipment, and hundreds of millions more just to design and develop the car itself. And that's just the beginning. That massive investment only covers your first model. Rivian and Lucid are often considered the most successful EV startups after Tesla. Both companies have already burned through more than $10 billion each. This makes the ambitions of smaller startups raising $1 to $2 billion seem almost naive, and it's not even close to what's needed for long-term success. Look at Lordstown Motors. They had it all: a massive former General Motors factory, personal endorsements from President Trump himself, and $1.1 billion in investor funding. Their promise? To transform an iconic Ohio manufacturing hub into an electric vehicle powerhouse. The reality? After burning through nearly all that cash, they managed to build exactly 31 trucks before their dreams came crashing down. Even with the White House's blessing and a ready-made factory, they couldn't crack the code of mass-producing electric vehicles. Then there's Fisker, and this wasn't even their first collapse. Back in 2009, the company, led by legendary car designer Henrik Fisker, convinced the US government to loan them up to $529 million to build luxury electric cars. However, Fisker Automotive only accessed $192 million of that loan before financial troubles halted further disbursements. They promised groundbreaking technology and stunning designs. Then it all fell apart. The first Fisker venture went bankrupt in 2013, leaving taxpayers on the hook for $139 million in losses after partial recovery of the funds. But Henrik Fisker wasn't done. In 2016, he launched a new company, Fisker Inc., raised fresh capital, and tried again. The result? The same story with a different date, filing for Chapter 11 bankruptcy in 2024. This time, they'd partnered with Foxconn, the company that builds iPhones, to manufacture their cars in a former GM plant in Ohio. They even had a stunning SUV called the Fisker Ocean rolling off production lines in Austria, built by Magna Steyr. But beautiful designs and big-name partnerships weren't enough. Manufacturing cars at scale requires more than visionary leadership and sleek prototypes. It demands an intricate dance of suppliers, precise manufacturing processes, and deep automotive expertise. That's what makes this industry so uniquely challenging. This is a perfect storm of complications. First, there's the technology itself. Electric powertrain components cost nearly 2.5 times more than traditional internal combustion engine parts. This creates immediate pressure on margins before a company has sold a single vehicle. Then there's the manufacturing challenge. Bringing a vehicle model from design to production typically takes 2 to 4 times longer than initially estimated. And that's not all. The regulatory environment is another mountain these companies have to climb. According to CNBC's analysis of EV startups, newcomers regularly underestimate just how tough federal safety requirements can be. We're talking about rules that can literally save or cost lives. The Federal Motor Vehicle Safety Standards, or FMVSS for short, cover everything from how a car handles crashes to the way its electronics are shielded. Mark Wakefield emphasizes that these barriers are aggressive and tough, precisely because cars can be lethal if not properly engineered. And the costs add up fast. The Wall Street Journal reports that meeting these standards often requires millions in additional engineering and testing that many startups haven't budgeted for. Even something as seemingly simple as ensuring doors work perfectly in all weather conditions can take months of testing and refinement. For established automakers, this is business as usual. For startups, it's often the difference between launching a product and running out of cash. Even when companies manage to navigate these challenges, they face what industry insiders call the noise, vibration, and harshness problem. Every component in a car needs to work in perfect harmony to provide a comfortable driving experience. And established manufacturers spend decades perfecting these details. New entrants often underestimate the complexity of this refinement process. Then, there's the thing about the market itself that has proven more challenging than expected. According to Cox Automotive, while EV sales reached a record 1.2 million units in 2023, representing 7.6% of the US market, the growth hasn't matched the optimistic projections that drove investment in the sector. The inventory of electric vehicles at dealerships has ballooned to 136 days supply, compared to the industry average of 78 days, indicating slower than expected consumer adoption. This slower adoption has created a brutal cycle. Companies need high volumes to achieve economies of scale and reduce costs. But without competitive pricing, they struggle to achieve those volumes. Without volumes, they can't reduce costs. It's a classic catch-22 that has trapped many promising ventures. The era of easy money that fueled the EV boom has ended. Rising interest rates have made capital more expensive and investors more selective. Many companies that went public through special purpose acquisition companies, SPACs, are now struggling to raise additional funding needed for operations and expansion. And even successful companies are feeling the pressure. Tesla, which controls 49.7% of the US EV market, has warned of slower growth ahead. Traditional automakers like Ford and General Motors have scaled back their electric vehicle investments and timelines. The industry is experiencing what one analyst called a shift from rosy to reality. And no, we're not done. The competition in the EV market isn't just fierce, it's ruthless. Traditional automakers aren't sitting idle while startups try to eat their lunch. According to consulting firm Alex Partners, these giants have pledged a staggering $526 billion for electric vehicle development through 2026. That's not just a big number, it's an overwhelming show of force. Ford alone is pouring billions into massive EV factories in Tennessee and Kentucky. General Motors is transforming entire plants to build nothing but electric vehicles. These companies have spent decades perfecting the art of mass production, and they're bringing all that knowledge to the electric revolution. But it gets better, or worse, depending on how you look at it. Listen, the real EV powerhouse isn't in Detroit or Silicon Valley, it's in China. Chinese manufacturers have cracked the code that every startup is desperately trying to solve: how to make electric vehicles cheap enough for everyday buyers. As reported in the Wall Street Journal, Chinese EVs are so cost-competitive that even with added tariffs, they could still undercut US and European prices. Companies like BYD have gone from making phone batteries to becoming Tesla's biggest global competitor. How? They've mastered vertical integration. They make everything from their own batteries to their own chips, controlling the entire supply chain from raw materials to finished cars. This is the brutal reality facing new entrants like VinFast, Vietnam's ambitious attempt to break into the EV market. On paper, VinFast's story sounds promising. They're backed by Vietnam's richest man, Pham Nhat Vuong, and they're planning to build a massive $4 billion factory in North Carolina. They even managed to ship thousands of cars to the United States. But recent automotive press reviews of their VF8 model tell a different story. Their vehicles showed worrying quality issues, everything from glitchy electronics to poor noise insulation and inconsistent build quality. These are the kind of problems that make buyers think twice before spending $50,000 on an unknown brand. The competitive pressure is becoming so intense that even successful EV startups are feeling the squeeze. Elon Musk himself warned investors in early 2024 that growth would be notably slower as competition intensifies. When even the market leader is showing signs of strain, you know the battlefield is getting bloody. The story of electric vehicle startups is, in many ways, a replay of the early days of the automobile industry. In the early 20th century, hundreds of car companies emerged, but only a handful survived. The same pattern of consolidation appears to be playing out in the electric vehicle era. And looking ahead, the companies that survive will likely be those with deep pockets, strong technology, and the ability to achieve economies of scale. Many predict that, just as in the early days of automobiles, only a handful of manufacturers will ultimately dominate the market. The story of electric vehicle startups often feels like déjà vu. Bold ambitions spark excitement, only to be followed by funding struggles, production setbacks, quality mishaps, and, too often, financial collapse. Over 30 companies have gone under, billions of dollars have vanished, and countless dreams of rivaling Tesla have crumbled. Still, the EV industry marches forward, though not as quickly as many had hoped. We know that electric vehicles will dominate the future, but only time will tell which companies will endure long enough to be part of that future.